Welcome to the Planet MicroCap Showcase Virtual 2022. I'm your host, Robert Kraft, and I'm pleased to bring to you the Stock Pitch World Cup, and it's Team Australia that's going to be presenting right now. Moderating Team Australia is Fadi Diab, better known as @thegladiator_HC on Twitter. I've known Fadi for a very long time. He's my go-to guy for all things Australian microcap investing. So with that, Fadi, thank you, man. How you doing?
I'm doing great, and it's fantastic that we're doing a Stock World Cup about 5 or 6 hours after Australia just won their game. So we're going to the round of 16. So I had no sleep, but it's worth it.
Absolutely, man. And look, I have no favorites in the Stock Pitch World Cup or whatever, but hey, let's hope Australia can do the same thing here, right? So, before we dig into some of the pitches that we're about to hear today, why Australia, Fadi? Real quick, for those who haven't been following or don't know what's going on in the Australian microcap community and the markets right now, why is this a time that you think folks should be looking at it?
Yeah, so if you look at markets around the world, financial markets, Europe and the US in particular, so you have a very strong VC market. So when you have new startups, new tech companies, new mining companies, technology, what they do is they normally go into the VC world. Those that become kind of successful, get valued at, say, 100 to 200 million market cap, they then list on one of the exchanges, right? In Australia, we don't have that. So what we have is a very, very strong and robust microcap market. So for example, to list in on the NASDAQ, you'd need somewhere around 100 to 200 million dollars market cap valuation. In Australia, we only have a 5 million valuation roadblock to get over. So what a lot of companies do is some of the best up and coming entrepreneurs and new companies, right? They come to the ASX from all around the world. They list. They obviously try their best to progress, and once successful, they'll dual list or they'll move into one of the largest stock exchanges. So we have access to some of the best up and coming companies globally because they simply can't list anywhere else. And if they don't want to go the VC route, the only other route is via the ASX. So we've got about last I ran my report just a couple of months ago. We've got about 650 companies with a market cap of sub 50 million, right? No other exchange has that. The Canadian exchange is pretty good in terms of breadth, but there's just no liquidity. So it's very hard to generate that liquidity there. We don't have that issue here. So for microcap investors, I think they definitely need some exposure to the ASX.
All right. Well, I think that's a great place to end it so that we can begin it. So with that, Fadi, let's dig right into Team Australia stock pitches.
Let's go. All right. Well, first off, for Team Australia, we have Matt Joss here from Maven Funds Management. Hey, Matt.
Hey, Fadi. Very happy to be here. Should I kick us off? Should I jump in?
Jump straight in.
Yeah, cool. I'll give a quick disclaimer. So we own this business I'm going to talk about, and I'll let anyone read the disclaimer if they want to work through it. Past performance is not indicative of future performance, all that good stuff. Very quickly, what we like to look for at Maven is businesses that we call monsters, kind of inspired by Thomas Phelps' 100 to 1 in the stock market. Basically, businesses that start out small, they tend to have a unique edge, have superior management teams, and are misunderstood. And that last part is really important. It means you have multiple times during the journey to invest, which can be really valuable, all based on some companies he studied back in the 1970s that increased more than 100-fold. And we think Mader Group has the potential to be one of those businesses. So Mader Group, we think, is a underfollowed capital compounder. It's repeating a proven business model, very high insider ownership, over 75%. The founder is still heavily involved in the business, upside to fair value, but most importantly, we think is increasing that intrinsic value over time. So I'll get into a bit more of what it is. It ticks a lot of boxes for us. I won't go through all this. This is kind of like the laundry list of stuff we like to look for. So what is Mader Group? So Mader was started by Luke Mader in 2005. He was working in the Pilbara. For anyone in the US watching, I think Western Australia, very dusty, hot place. He was working as a diesel mechanic for some of the big mining equipment. So, diggers, dump trucks, that kind of thing. And he saw an opportunity. He was working for one of what you call the OEMs, the original equipment manufacturers like Caterpillar or Komatsu, who make them equipment. And then when you need to get your car serviced, you typically go back to the place that you bought it from to get it serviced. What he saw, though, was that those incumbents, when it came to servicing, they kind of saw it as like a cash cow. So, it was really, they offered an expensive service. It was quite slow to respond to customers, kind of difficult to work with, high quality technicians, but just not providing great service, and didn't treat their workers that well as well. And these are really, skilled people, basically, these diesel mechanics. So he saw it as a recipe ripe for disruption. He launched Maven himself and a few mates, and it basically grew from there. And so it's grown extremely well, as we'll touch on. But just to nail down that business model, so Maven's kind of in the middle between these original equipment manufacturers like Caterpillar and their servicing, and smaller operators and labor houses. And so what Maven does, it's cheaper than those OEMs, those original equipment manufacturers, but it offers a faster service, and just a really high quality, high morale staff. But it's also, so that makes it basically better for people to use, versus the OEMs. But it's also got advantages versus the smaller end of the market because it has scale. It's the only operator that really reached scale, and now global scale. Really good systems means that because of that scale, it can respond more quickly to customers, basically, and get things fixed, which is a big deal because, if this mining equipment's down, the mine loses potentially hundreds of millions of dollars. So Maven today, again, started in 2005, guiding to over 550 million of revenue, over 2,000 staff, CAGR the last 5 years of over 30% for revenue. And again, that's during COVID, which is kind of a tough time for this business because it's a labor business. You don't want to be locked out of an area, as they were for a while in WA. And so, guiding for another 36% growth this year in the latest guidance, which was recently upgraded. Q1 revenue growth was 48%. I'll get to that again in a sec. I think it's got a bit of a flywheel. Everyone talks about these these days, but essentially, as it scales, it's offering a better service to its clients and a better place to work for its employees because they get to be deployed more frequently and with more variety. And that variety is a really key point because these diesel mechanics don't want to be stuck in the same, boring mine out in the dusty Pilbara. They like to move around. They like to have some variety and try different things. And Maven now, particularly with international, means that they can offer all sorts of experiences all around the world. Their staff are typically young, energetic, mostly men, young, energetic girls as well that want to travel and see the world and try different things. It's scaling the same type of model in different verticals within that diesel mechanic and now fixed infrastructure and Maven energy. But it means that they've got a model that is being replicated repeatedly, and it's now growing into larger markets. So the North America, Canada, etc., which are also higher margins. So the margins in North America, EBIT margins are almost twice as high as in Australia, which is where they're dominant today. And it's kind of a rare story, I think, scaling an existing model into larger markets that are also more lucrative. What we think the market's getting wrong, so what we think is misunderstood, and the same reason I didn't like it when I first saw it, was it's a mining services company. And a lot of mining services companies typically, at least throughout a cycle, kind of suck. They're capital intensive, very cyclical, very levered to the exploration or construction phase of mining. So that big, peak of the boom, a lot of mining services companies are used. But Maven is different because it's focused on maintenance work. It's really about, is the mine operating, not, is it expanding or exploring? So it's just tied to production, basically. As long as the mine is still producing a lot, it's going to need equipment which wears down and needs to be maintained. It's also got quite modest capital requirements. In Australia, they're just a Hilux to travel out to the site. That means it has quite high returns on incremental invested capital of 25 to 30% by our estimates. And that's quite different again from traditional mining services. A lot of those companies are often, they need, big expensive drilling equipment and other capital intensive stuff, which means that you don't really see the cash during the good times. But we think Maven has been able to expand, organically as a result of that. Again, production, not exploration or construction. And it grew throughout the last mining boom. So we look back at how other mining services companies performed during the kind of mining crash in 2012 to 15. Maven Group still continued to grow revenue during that period, was still profitable. It did take, it wasn't completely smooth sailing. Profit margins took a bit of a hit, but it's still growing, quite strongly during that period. And that's quite different to other companies that we looked at. So we looked at 11 publicly listed mining companies during that time. 4 of those went out of business altogether. Of the 7 that survived, their average revenue fell by about 15%. So basically, we think the market's getting it wrong because it's kind of lumping it in with other cyclical mining services companies. Aligned A players, really high quality team. Again, the founders and directors own about 75% of shares. The senior leaders are all incentivized to hit organic revenue growth targets, not through acquisition, and profit growth targets, not revenue growth. So really aligned with shareholders, we think. And everyone I've dealt with there is just kind of an A player, I guess is how I'd frame it. The CFO's also off starting a business in the US. The investor relations person's also a really important marketing and recruiter person for their most important new expansion. So just a really high quality team. We did a lot of scuttlebutt, talked to some competitors. Here's one that we asked about how Maven compares. They said, I don't think it's a comparison. To be fair, Maven's in a league of their own. They're far, far above. They've got a huge reach with money. They have the ability to have marketing departments advertising everywhere. That was about attracting employees. And then from the customer's perspective, everyone knows that Maven is the go-to because they are going to be able to get people to your site. And that's really key. And that's where scale kind of becomes an advantage. There are some risks. So I think China slowing down is something that I'm watching. Iron ore is still 40% of the business, although that's shrinking as Maven expands internationally and into other business lines in Australia. But, China needs iron ore to make steel. It needs steel traditionally to make a lot of infrastructure and apartments. I think both of those could slow down quite aggressively. So that's something I'm watching. On the positive side for Maven, though, its customers that it works with are typically the lowest cost iron ore producers. So if you think of the cost curve in mining, we would expect them to still be producing tons, even if prices fell quite significantly. And that's really what drives Maven's business, is that they're producing tons, wearing out equipment that needs to be maintained. And also Maven can redeploy labor if some areas are hot and some areas are cold. So provided that, the whole world isn't all cold at the same time, I guess, there's still that ability to redeploy labor, say from Australia into the US and other areas that are booming. There's also the risk long term of if the culture breaks down. We think Maven's culture is a really key part of their growth. So at the moment there, as I said, that most recent quarter, over, I think, around 48% revenue growth, but that was really driven by 2 areas. Australia is still growing very fast, over 30%, but the North American area, which includes a newly launched Maven Canada, a Maven energy business, and general North America business, it grew over 200% that quarter. Extremely strong. The business has kind of potential to grow fast into a much larger market. And currently, America is much smaller than Australia, but we think it can grow to be much larger over time. Other verticals include fixed infrastructure as well in Australia, so quite a lot to work with. I won't go through all this, but we think they've got kind of small compounding modes. So culture is really hard to imitate. Got a quality reputation, scale and utilization, better systems. It's all just kind of adding to each other. There's nothing that when you first look at this, it jumps out to you, but we think that in combination, it's really powerful. So that was all the kind of quick run through of the pitch, and hopefully hit 10 minutes. But happy to answer any questions that you might have.
Awesome. Thanks, Matt. That was really good. Firstly, just to confirm for those that are listening, I don't own any Maven shares. I did note down a few questions, Matt. First, around the leadership team. So they've got the founders got 56% of the shares, 75% sitting with the board level employees. So, if I can see here, Jim is probably nearing retirement age, owns more than half the company. Have you spoken to them about a potential succession plan? What's their plans when he eventually decides to take a break or move on? Or
so it's Luke, Jim's non-executive chairman, kind of brought in as a professional chairman before the IPO, but Luke Maven is the founder that owns about 56%, and then another director, Craig Burden, owns the rest. He has kind of passed down already. So Justin Newich is the CEO. Luke's not CEO. He's his role is strategic growth. So he was really fundamental in going to the US and driving that. He's still heavily involved in the business, but he's not CEO. And I think it's a good balance. Like, I love founder managers, but this is now quite a scaled business, right? You kind of think of Luke and his startup days in a truck in the Pilbara. I think he's, like you classically see a founder, the biggest driver for him, I think, is keeping the culture alive. I really like the way that he's designed incentives so that the rest of the team aren't incentivized to grow by, acquiring other businesses. It's driven around organic growth. And so I think he's there, to keep them like being aggressive around growth and to keep the culture alive. And I think it's a really strong kind of team as a result.
Okay, cool. And I know the mining sector pretty well because it's one of the sectors I'm very bullish on. But if we do experience, from a macro perspective, some kind of global slowdown, which is kind of predicted by everybody these days, which probably means it won't happen. But if it does happen, then obviously mining will be impacted. Even though there would be so obviously some mines will still be operating because you're focusing on just those that are in production. There would be a slowdown. So what's the balance sheet look like if we do go through some kind of 2 to 3 year slowdown globally and mining companies, giving the classic example of iron ore, reduce their production?
Yeah, it's a great question. So they do have some debt, which is basically related to the vehicles that they purchase, but it pays a dividend and has been, internally funded this whole way. So it's not aggressive debt for expansion. I think they keep it quite conservative, tying it to how much receivables they expect. It's a percentage of their receivables. So I think that Luke's basically always planned it kind of conservatively in that sense. It's also one where you'd get a lot more cash flow if they did stop growing because they're kind of constantly reinvesting so much into growth for CapEx. So, both on a working capital and a CapEx sense. So I think that you'd see profitability could fall during like a global recession, but I think you'd actually see a lot more cash flows come through at that time. And again, I think we'll see it if it happens. But I think the other thing is just their ability to focus on production rather than growth. So as long as those mines are still producing, and typically they're not with the high cost. Probably in Canada they are with some high cost producers and the oil sands there, but a lot of their the rest of their businesses typically focus on lower costs. So those mines would still be operating, would still need to put out the tons. You don't really see tons dip that much. You see price. So that's where we think it would survive. But of course, the proof will be in the pudding during the next downturn.
Yeah, and let's look at the other side of the coin because I'm hugely bullish on metals, battery metals. Zinc, lithium, nickel, graphite, etc. We've seen the maps or the graphs that have said we need 100 new graphite mines, X dozens new lithium mines. So, and that's all going to be in the next 10 to 15 years. So, if we do experience a big boom, which is something I'm thinking about, how quickly can they grow to be able to service that demand?
They can grow very quickly. So in the United States last quarter, year over year, they grew 200%. It's really constrained. It's typically a labor constrained business. So it's trying to attract the best, talent, diesel mechanics. And that's mostly the handbrake on that growth. But I say handbrake again, they still grew 200% in North America. So yeah, that's basically it, is how fast can they get talent in? And that's where it kind of comes back to all those advantages that they try and build of having been a great place to work, having variety, etc. So I think that they kind of thrive in this environment where we have tight labor markets, but they're the best place to go. But yeah, that's what interests me about it, is they can scale very much up. They see Canada particularly as exploding, as you described, as like a vortex. So yeah, I think they can, but they're not, again, tied to the exploration phase. They should hopefully ride up, as I agree with you that there's a huge potential for this mining for green mining or whatever you want to call it over the next few decades. So yeah.
What have they done in the last year to kind of? You spoke about the tight labor market. It's an issue everywhere at the moment. So did they do anything innovative to actually be able to find people and not have to pay them an extra 50%, which is going to reduce their margins and probably have a lot of these mines reduce a lot of the work that they're doing in the space? So what have they done in the last year to combat that?
Yeah, I'd say it's like a lot of small things. So they have a reputation in the industry that's good. They say when people join, they're kind of stunned that they have such a tight culture, which they just don't get, particularly if they're competing with a lot of mining employees and labor houses, and there just isn't the same, I guess, drive there. They'll do stuff like, give away promotions, maybe sign someone up, they can get a dirt bike or some other promotion or something. But other kind of structural things is their best employees often get to be deployed overseas. So they have an international division as well outside North America. These young guys love to go and work in Africa or somewhere and have a lot of fun there and experience new things. They just recruited people, bringing them from Australia into Canada. So that's been a big recruitment drive. So it's just been, using their scale and being smart about how they market to people. It's not one thing that they've been able to do that I've seen. It's just a lot of operational excellence, I guess, trying to get people in.
Awesome, thanks. And I'll just share a story to finish off. Many years ago, the Pilbara is known. I'm glad you shared the area. Is known in Australia for Pilbara metals or minerals, which is a big $15 billion lithium company. I bought them when they were 2 cents, many years ago, and before I had any idea what I was actually doing. Ended up selling it for 3 cents because I got bored, and they hit a high of $4 this year. So that Pilbara area will forever be etched into my memory. So thanks for reminding me again of that.
That's an incredible story. Apologies to remind of it. No,
oh, good. Fadi. Well, thank you, Matt. Thank you so much for your time and for sharing that great info.
Thanks for having me.
All right. So next up, we have Michael Wu, who's a full-time private investor from Melbourne in Australia. Michael, how are you going?
Yeah, good. Thanks, Fadi. Thanks a lot for having me on this program. It's great to be part of it.
No, great. Thank you for coming. And today you're talking about SOM. Is that right?
Yeah, that's right. So the company I'm presenting today is SomnoMed, and it's a medical device maker. The ticker is SOM on the Australian Stock Exchange. And I'd like to disclose that I currently hold a position in the stock mentioned. So first of all, SomnoMed creates oral appliances to treat obstructive sleep apnea. It's truly a global company with roughly 55% of revenues coming from Europe, 40% from North America, and the remainder from the Asia Pacific region. It's currently the largest oral appliance maker in the world with a market capitalization of 114 million Australian dollars. Obstructive sleep apnea is a serious disorder where the sufferer repeatedly stops breathing while they are sleeping in the middle of the night. It generally happens when the throat muscles relax and blocks the airways. Some symptoms include loud snoring and being drowsy throughout the day. However, if left untreated, it could lead to increased risks in heart attack, stroke, diabetes, and heart failure. It's a severely undiagnosed and very common condition with an estimated 1 in 5 males in OECD countries currently suffering this disorder. The CPAP machine, where a patient wears a mask and has air pumped into their mouths and nose, is currently the gold standard treatment for OSA. The companies that make CPAP machines include ResMed, Fisher & Paykel, and Philips, and they've all been very big multi-baggers over the past decade. The CPAP machine is very effective. However, it's hard for patients to tolerate. As high as 50% of patients treated with CPAP give up within the first 6 months. Surgery is another but much less common type of treatment, and it generally involves the removal of tonsils and reducing the size of the tongue, or reducing some of the soft palate within the mouth to remove any obstruction. Oral appliances are the least intrusive of all. It's a customized mouth guard that brings the lower jaw forward to open up the airways. And more importantly, it's very effective at treating mild to moderate forms of sleep apnea. It's also very easily tolerated. So once a patient starts using one, they usually don't stop. There's no need to wear a mask, no air being pushed down your throat, no electricity required, no regular cleaning of tubes or masks, and no noise. So I believe SomnoMed is interesting for a few reasons. Firstly, its underlying top-line performance is very strong and has been obscured by some company-specific and macro events recently. From 2017 to 2019, the company engaged in a pivot of strategy in the US in order to prevent dentists from overcharging for the appliance fitting. SomnoMed established its own sleep centers and its own fitting practices. When dentists caught hold of this, they began boycotting the product. And by late 2018, the company admitted defeat and reverted back to their previous business model. The whole ordeal set the company back around 3 to 4 years in North America. The second event was the global pandemic. So during the depth of the pandemic, sleep centers and dentist practices were closed. So patients couldn't get diagnosed for OSA and they couldn't get fitted for an oral appliance. But during 2020, even during 2021, the stress on the hospital systems, especially in Europe, reduced the ability for patients to be treated for OSA. Despite these two events, the company managed to grow its top line by 8.7% over the past 6 years, but this underrepresents the underlying performance. For example, the European division, which was not affected by the pivot of strategy in the US, grew by 20% per annum in the years preceding the pandemic, outpacing the CPAP market darlings. The company grew 17% on a constant currency basis last financial year and is guiding to grow at above 20% this year. Another reason the company is interesting is the upcoming introduction of an internet-connected version of its oral appliance. In 2019, the company conducted a wide-ranging survey with sleep physicians about oral appliances. It was uncovered that one of the top reasons that physicians were skeptical about prescribing oral appliances was due to the lack of real-time monitoring and of effectiveness and compliance. SomnoMed is currently attempting to address this shortfall with a product called Rest Assure, an oral appliance with electronic sensors embedded in the device that will track the effectiveness and compliance throughout the night. The data will be made available to the patient and the sleep physician so they can monitor and discuss about the effectiveness of their treatment. Regulatory submission to the FDA and other regulators are happening right now, and commercialization is expected in April 2023, with the device in patients' mouths by the end of 2023. Rest Assure is a game changer and brings monitoring in line with the high-end CPAP machines. It's intended to address the concerns of sleep physicians and encourage them to prescribe more oral appliances over CPAP. Should the product be successful, it will likely improve demand for SomnoMed's offerings. There are also some tremendous tailwinds. The OSA treatment market is expected to continue to grow at between 6 to 12% per annum over the next several years. Taking the US as an example, it is estimated that 80% of people with sleep apnea is currently not diagnosed and not treated. Oral appliances only account for 10% share of the treatment market. In Scandinavian countries, this share can be as high as 50%. So the potential is very high to improve share in the US and also other Western European countries. And finally, it's trading at a price that puts it on a very undemanding valuation. It's currently trading at just 1x sales with a 60% gross margin across the group. The company is targeting over 20% revenue growth per annum over the next few years. In 2021, the company was also free cash flow positive, but the CapEx investment into Rest Assure pushed it back. But the company has enough funding to get back to free cash flow positive, which should be only a couple of years away. And that's my pitch today. So yeah, thanks,
thanks Martin.
For your
Very
time, everyone.
My father actually has sleep apnea, and he gave up within 6 months because he couldn't take the machine.
Yeah, you should get him hooked up with the SomnoMed sales team and see if he can give it a go.
I've been to a few of the appointments with him. This was never raised as an opportunity. So are they targeting Australia as a market, or
yeah? So SomnoMed,
US?
SomnoMed is an Australian company that was established in Australia, and maybe around 5% of the current revenues is Australian based. So they definitely have a presence here. But I think the CPAP manufacturers have just got a great marketing machine going on that have convinced a lot of physicians that it is the right way to go. So there's just been a whole lack of awareness for oral appliances itself.
And what's the cost of the mouthguard product?
Yeah, the mouthguard product. So generally in European countries and probably in Australia as well, it's about $1,000 US for the appliance itself and also fitting by the dentist. Now, this can get it quite a bit higher in the US, especially if the dentist is gouging the price a little bit. It can get as high as 3,000 US.
Wow.
Yeah, so it really depends on whether you get handed the right dentist to do the fitting or not, really.
Right. But I'm assuming the manufacturing cost would be quite low for such a small product.
Yeah, absolutely. I think it's the device itself is around $500.
Yeah, and I'm not sure how it works in the US or Europe, but I know the CPAP machines in Australia, the government funds part of that on behalf of the individual through Medicare. Would this device fall under the same category of medicine where the person can get some money back if they decide to purchase it?
Yeah, I'm not sure about the reimbursement within Australia, but Europe especially, a lot of the Scandinavian countries, Germany, Netherlands, the oral appliance is fully reimbursed. In the US, there's reimbursement as well. So it's on par with CPAP in terms of reimbursement. It's probably not 100% as applicable as them.
Okay. A couple other questions around the Rest Assured product. That would be a game changer. Is that additional revenue coming in to the company for that, or is that just an additional add-on that the person could get for the original purchase price?
Yeah, I think it's an additional add-on. So it won't be a different line that will increase revenue. It's more to help sales to the physicians because it offers compliance and effectiveness monitoring. So it's an easier sell for physicians. So they have some way of monitoring the effectiveness of their patients.
It would be, because I'm sure the CPAP, because my father's experience was you spend overnight and then they'll give you the results when you're in the actual clinic. But when you go home, I don't know if the CPAP machine actually gives you the results overnight of how you're breathing.
Yeah. So I know the high-end ResMed machines, they would, record the data and send it off to the cloud. So both the physician and the patient have a view of that. Okay. So that's the gap it's trying to bridge there.
It's very important. So the last question I had is if they have a 70% margin on the product, then why aren't they free cash flow positive? Is it do they have debt, or is it where are their costs coming from?
Yeah, so they were free cash flow positive in FY21, but in the past couple of years, they've been spending more money on this new technology product, Rest Assured. So that's just put them back into cash flow negative territory. But in a couple of years, when the sales ramp up again, they should be really in cash flow positive territory again. They're not too far off that.
Well, awesome. Well, that was fantastic. Thank you for the pitch. Actually, a really exciting company. I might add it to my list to do a bit of research on. So thank you for your time, Michael. Any final comments?
No. Yeah. Thanks for having me, Fadi. Much enjoyed it.
Awesome. Thank you, Michael. And also, just to disclose to everyone listening, I don't currently own any shares in this company, just for compliance purposes. Okay. Next up for Team Australia, we have Dr. David. David is a full-time investor. He's a medical doctor, and he's an advisor to a company called 62 Capital. David, how are you going?
Very well. How are you, Fadi?
Great, thanks. So today you're going to be talking to us about Emeria.
Correct. So I guess just to get the ball rolling, I personally am a shareholder of Emeria. It's an ASX-listed company. a clinical stage biotech company with a focus on neuroscience and mental health. I guess just perhaps to give a snapshot, it's best to start off talking about its clinical development programs. So the company is currently running phase 3 trials on its ultra-pure solid oral dose form EMD-RX5 for an over-the-counter opportunity with the TGA, the Australian regulator, to treat the symptoms of psychological distress, and is also in the process of developing a number of other solid oral dose forms of cannabidiol medicine for major FDA indications. In addition to that, investors would have heard a lot about the psychedelic assisted medicines, and the fact that it has attracted a lot of investment in the last few years. So what's very, very interesting about Emeria is that they have executed a relationship with the University of Western Australia to develop what has become now one of the largest libraries of unique chemical entities inspired by MDMA, otherwise known as ecstasy. So that is very interesting, and I'll be happy to give you a bit of an explanation as to where the company is and where it plans to be in the next 12 months. We might just start by rolling on to the next slide, just talking about the cannabinoid program. So, yeah, what's very interesting with Emeria's technology is that they have developed, a world-first proprietary formulation that delivers a very, very ultra-pure cannabinoid, a synthesized cannabinoid in a solid oral dose form with a very, very high bioavailability. And that is very, very important because it basically allows the company to more readily engage with major global regulators to develop registered medicines. And I guess perhaps if we go on to the next slide, we can understand a little bit more what that means. So, I know that seasoned investors in sort of small cap companies would be very well aware of the sort of the boom in cannabinoid medicines over the past 5 years. I guess what is less well understood is the fact that a lot of these cannabinoid companies are not aiming to develop registered medicines, which, in my opinion, which in my opinion basically is a much clearer way to develop much larger valuations within a business. So a good example of that is a product called Epidiolex, initially developed by GW Pharma and more recently acquired by Jazz Pharmaceuticals. Now this, for a very long time, was the only registered FDA and TGA medicine using cannabidiol for, and that's basically for some sort of rare form of seizure disorder. And it just, based on the acquisition in 2021 of US $7.2 billion, you can see that, having a registered medicine can drive far more value than some of the, than developing a product and driving sales through other channels. So what really attracted me to Emeria is that they're on track to basically running the required trials with a proprietary product to achieve registration and hopefully replicate some of the value that GW created by doing the same thing within their business. So can we just go to the next slide, Rob? All right. So look, the Emeria's first dose form, EMD-RX5, which is currently in phase 3 trials. The company ran this product through a phase 1 earlier this year, and they did that head-to-head with Epidiolex, which, as I mentioned on the previous slide, is the only FDA registered cannabinoid medicine. And basically, good news for Emeria was that it was very performant compared with Epidiolex. So it had equivalent bioavailability. It had a slower, more stable release profile, and because its EMDRX5 is formulated with ultra pure synthesized cannabinoids, it had less impurities and lower metabolite measures. So I think we'll go to the next slide, Rob. Thanks. Great. So this is in my opinion, a great snapshot of of the performance of the Emeria dose form. Obviously, very similar or statistically equivalent to the bioavailability of Epidiolex oil. But more importantly, if you look to the right-hand side of those two bars for Epidiolex and the MDRX5, you can see that the MDRX5 capsule is far more performant than any of the other players who are sourcing their products from the traditional cannabidiol oil. So not only is it a much purer, more standardized product, which allows the company to engage more readily with the regulators, but it's far more bioavailable, which means that a certain dose of the medicine can be absorbed at a much greater rate within the human body and have much larger clinical effect. We'll go to the next slide, please, Rob. Right. So just wanted to touch on the phase 3 trial, which is currently underway. So the first indication that Emeria is seeking to gain registration with the TGA is for the symptoms of psychological distress, and basically the company is aiming to meet the criteria to get what is known in Australia as the S3 registration, and target a major over-the-counter market in an indication which is psychological distress. Current estimates of that product in that particular market is up to sort of, and this is just Australia alone, is up to $40 to $50 million a year. And the company is planning to use the registration here in Australia as a launching pad for major registration programs in the US in mental health and pain. So we'll go to the next slide. All right. So just a little bit about the MDMA-inspired drug discovery program. As I mentioned earlier, Emeria has a relationship with the University of Western Australia and a gentleman by the name of Professor Matt Piggott, who is a globally renowned expert in amphetamines and MDMA. Go to the next slide. So what's very, very interesting about this relationship and what has been achieved to date is that Emeria and UWA have essentially curated the largest known, as far as I'm aware, database of novel MDMA analogs, with now over 140 unique compounds comprising the library. And those 140 compounds, demonstrated stability and purity with preclinical screening. Now, based on the work that Emeria has done to date, there are a number of indications that have popped up as potential lead areas for future development, all the way from neuropsychiatry and anti-fibrosis treatments. Next slide. So this is just basically a summary slide of the company's the steps the company is taking to develop these novel molecules, basically taking MDMA as an inspiration, designing and synthesizing new compounds for superior clinical effect or potential clinical effect, screening those compounds, segmenting those compounds into priority indications, which, as I mentioned, in this case, is mental health, movement disorders, and non-neurological conditions such as fibrotic diseases, and then advancing those lead compounds through to clinical studies. Next slide. So, although it's perhaps no surprise that the market has been quite difficult over the last 18 months, still we find that companies developing novel psychedelic medicines are attracting significant valuations globally. And, this is, a big reason which attracted me to become, a shareholder of this business alongside the late stage cannabinoid program, was that, Emeria has an immense amount, in my opinion, has an immense amount of potential with a huge database of novel compounds to advance over the coming years. If we look to some of the North American markets where psychedelic assisted therapies are more well understood, we can see that Emeria today is trading at a fraction of some of the other businesses that are looking to advance these novel therapies. So, I know that the company at the moment is in a preclinical phase, but fast forward, 6, 12, 18 months, once these preclinical studies have been completed, I think that Emeria will be sort of, very advanced compared to its peers globally, but particularly, on the Australian exchange. Next slide. Yes, so, as I touched on before, over the next 12 months, Emeria intends to deliver results from multiple preclinical programs on select MDMA analogs. There are a number of, trials ongoing in the US and Australia. Obviously, they've got a massive pool of, 140 screened molecules at the moment and growing. So the next, phase is going to be basically taking the results from the preclinical screening, selecting the best leads for each of those potential indication pigeonholes, and then moving on to efficacy studies in animal models. I've been told that the company will continue to expand the MDMA analog library, and a big part of expansion of that library and advancing those programs is filing additional patent families and then working to commercialize those assets. And again, I think one distinction needs to be made. I know when perhaps rewind 12 months where there was a lot of excitement over the renaissance of psychedelic therapies. I think we've got to sort of look at the commercial reality of a lot of these programs, whereby it's very hard to sort of get a foothold in intellect, and develop a significant IP position for established molecules of LSD, psilocybin, and MDMA. I think if you are improving the performance of those molecules through development of novel analogs, there's a much clearer way of defining commercial value for companies in the sector. And I think that's where Emeria really shines, and that it's got a very, very large asset to develop in the coming years. Next slide. Yes, so just a bit of a summary, sort of encapsulating what we touched on before. So, number one, Emeria has developed a world-class proprietary ultra-pure CBD product with more formulations on the way, and its lead formulation in phase 3 studies in order to try to basically aiming towards developing a registered medicine in Australia as the first step. It has no THC or impurities, a high bioavailability and low patient variability, and slow release in its action. And this particular dose form can support multiple indications both in Australia and the US. It has perhaps we didn't touch on it as much as I would have liked, but the company has the largest curated real-world data set on cannabinoid medicines, and it's using that massive data asset to power its clinical programs, particularly with reference to its cannabinoid programs. It has a substantial R&D pipeline of MDMA analogs in partnership with a leading Australian university, and all of this work is basically being done by a world-class team with a number of major previous FDA and TGA registrations. So the company is in very good hands to basically achieve its goals, because we're basically being led by a team that has done this before on many occasions. And I think that's all we've got from our end. I think I'll hand over for some questions, if that's okay at this point.
Yeah, perfect. Thank you, Dr. David. Just before I kick off, firstly, I'll just confirm that I am also a shareholder in Emyria and have been for about 18 months now. And so, yeah, David, thank you for that. I think Emyria, from an investor perspective, obviously I'm a shareholder, so I think very highly of it. But just even from a societal perspective, I think it's going to bring so many benefits to people. And if I use a personal example, I have a family member who had bowel cancer, and even though cannabinoid products over the counter are legal in Australia, there's no TGA product that's actually approved to be sold to patients. And so even though she was trying to get her hands on some cannabis products just to help her in the end of her life stage, she couldn't get anything.
Yes.
So I think it's going to bring a lot of relief to patients. And she actually passed away only a few days ago. So when it comes to real life examples, these companies aren't just there as tools or vehicles to make some money, but they're also bringing some real benefits to society, which is great. Just from a question perspective, I think it's very clear on their cannabis product, the pipeline that's coming up and the things that they still need to work through. But from the MDMA and psilocybin perspective, like you said, it's a sector that's getting a lot of traction, especially in the US. But what's going to be the trigger for Emyria to actually take this forward to potentially doing some real studies on animals and sooner or later on humans?
Yeah, look, that's a very, very good question. I mean, I think that's the crux of it, really. What does the future look like? How do we get these patients advanced to the point where we've got confidence to take them through clinical programs? So I think although it's perhaps the more boring stage in a company's life cycle, over the last 12 to 18 months, the company has steadily been working through, from what I can see, been working through its preclinical screening program. So basically, that's the first step needed to narrow down, which of those 140 plus compounds are interesting for various reasons, to move them further down that preclinical pathway to get to a point where we can start making overtures towards a clinical program. So that basically comprises of screening. So I think that they've done a lot of work with the European company Eurofins. They have done some work in metabolic studies, and I think that they referenced some of that in a recent presser where they looked at the half-life of these analogs. So they've taken all of that information. They're now doing some animal studies with psychogenics in the US. And basically, the outcome of that is really to get to a point where they've got a number of compounds that they can start to really move towards a clinical pathway. So I think there's nothing that's stopping that moving forward. It's just a matter of time, and I think we're well advanced along that journey.
Awesome. And as my last question, and you touched on it very briefly around our leadership team, our management team. Can you just talk briefly about who they are and a bit of their experience? Because I know we've got a link to GW Pharma and the product that they have released.
Yes. Look, I mean, I think I didn't include a slide.
That's okay. You can just talk about it. Yeah.
Yeah. Okay. I'll just get So basically, we're led by a gentleman by the name of Dr. Michael Winlow. So he's the managing director of the company. He is he's a medical doctor. He's done his MBA at Stanford. Previously worked at Palantir over in the US, and Linear, which is a clinical research facility here based in Western Australia. We've got Matt Callahan, who's a founder and a non-executive director. He's got 4 FDA approvals behind his name. He's had significant venture capital experience and a background of having a successful exit from Isutica to Iroko. And Dr. Stuart Washer, who's the executive chairman, another founder of the company, founded multiple ASX companies involved in multiple trade sales. And Professor Sir John Took, non-executive director of the company. He's a gentleman based over in the UK. He's, knighted for services to medicine. Clinical research. He's a lifelong clinical researcher, and he's also an advisor to the NHS. We've also got one further team member I'd like to touch on, Dr. Karen Smith, who is the US executive director. Very, very accomplished C-suite executive, has overseen 20 FDA approvals plus in her career, with multiple billion-dollar M&A, acquisitions. And funnily enough, she also had a role at Jazz Pharma. And that was the company I referenced earlier in the presentation that acquired GW Pharma with Epidiolex as its lead asset.
Awesome, fantastic. Well, David, thank you so much for your time today. Very interesting company, coming from a shareholder. And so you wrap up our Australian team here. So thank you for yourself and everyone else who participated in this series. And we'll speak soon.
Thank you very much.
All right. Well, that does it for the Stock Pitch World Cup Team Australia. Fadi, thank you again for moderating all this. For folks to follow you, where can they go and get everything they need to stay up to date with the Gladiator HC?
Yeah, well, the main place, to be honest, is Twitter, at the Gladiator HC. All of the things I'm involved in kind of center around being communicated via Twitter. So if you follow me there, you'll find out everything that I'm doing.
Very good. All right. Aussie. Let's go. All right.
Awesome.
All right, Fadi. Thank you very much, man.
Thanks, mate.